All right, let's dive into W.R. Berkley's latest earnings. The property and casualty insurer just reported for Q4 2025. And here's the thing, they beat expectations, but the stock? It barely budged. So what's going on here? Let's unpack it.
Okay, first things first, let's look at the headline number. W.R. Berkley delivered GAAP earnings per share of $1.13. That came in just a penny above what Wall Street was expecting. So, a beat is a beat. It's solid, even if it was a narrow one.
But this is where it gets really interesting, right? The stock just kind of shrugged it off with a little 1.6% bump. Now look at this. The options market, which is basically Wall Street's betting parlor for volatility, was braced for a huge move, over 6% in either direction. So the big question is, why the yawn from the market after a quality earnings beat? That's the puzzle we're solving today.
To figure out that disconnect, we've got to pop the hood and see what's really driving things. And this quarter, Berkley's performance was all about two key engines firing on all cylinders.
Engine number one, and this is the absolute bread and butter for any insurance company, is their underwriting profitability. I mean, this is the core of their business, right? It's all about whether they're making money on the actual policies they're selling.
And wow, did they execute well here. They posted a combined ratio of 89.4%. Now, for those of you who don't live and breathe insurance metrics, just remember this. Anything under 100% is great. It means they're making a direct profit from their insurance policies. And not only is that a really strong number on its own, it's actually better than the 90.2% they did last year. That, my friends, is what disciplined, profitable growth looks like.
Okay, on to the second engine, which was absolutely humming this quarter, their investment income. See, insurers take all the premium money you pay them and invest it. And in a world with higher interest rates, this has become a huge part of the story for the entire industry.
And just how big a deal was it for Berkley? Well, they pulled in over $338 million in net investment income just for the quarter. So, yeah, with rates where they are, that giant pile of investments is acting like a massive tailwind, pushing their profits higher.
So you've got both engines running strong, the core business is profitable, and the investments are kicking in cash. Now let's pivot and listen to what management had to say about the road ahead. What were the key takeaways from the earnings call?
Naturally, everyone on the call, all the analysts, wanted to know what's next. What kind of guideposts did management lay out for 2026?
And they gave us a really concrete piece of guidance here. Management came right out and said, quote, "We expect that our expense ratio will continue to be comfortably below 30% in 2026. That's a huge signal, It tells you they're laser focused on keeping costs in check.
The Q&A part of the call, as always, is where you really see what's on investors' minds. And the big questions were all about the key variables, stuff like, how much longer can they keep raising prices on commercial insurance? Are they budgeting for a normal hurricane season? And, a big one, they've got this new share buyback program, so how are they going to use it? These are definitely the things we need to keep an eye on.
To their credit, management was super candid about what they're seeing out there. They pointed to some real bright spots, especially in small account casualty and E&S, that's excess and surplus, which is basically insurance for the weird, hard-to-place risks. But they didn't pull any punches on the challenges either. They called the market for big property insurance a feeding frenzy of competition, which, wow. And they confirmed auto liability is still a huge headache for the whole industry.
All right, let's put all the pieces together. We've got a company that's executing beautifully. We have a management team that sounds confident but also realistic. And we have an industry that's got both tailwinds and headwinds. So what does it all mean for the stock? It's time for the next call.
Okay, so for our outlook on the next quarter, we're calling it mixed. That awesome investment income isn't going away, but we think those rate increases are going to start to slow down. And that feeding frenzy of competition they talked about, that's going to put a cap on how fast they can grow premiums. Because of that, we see the stock's price action as basically range-bound from here. Look, the company is so high quality, it puts a solid floor under the share price. But that quiet reaction on earnings day, it tells us the market already knows this. The good news is pretty much baked in. And that's why we're slapping a market perform rating on it.
So, there you have it. Our final rating is market perform. Bottom line, W.R. Berkley is an absolutely best-in-class company, but the stock price already seems to reflect that.
Now, just for fun, let's talk about a potential trade idea here. And again, this is just to get you thinking. The core idea is this. You've got this top-tier company, Berkley, but it's operating in a tough neighborhood. The whole industry is facing headwinds. Pricing is slowing down, competition is heating up, and you have this thing called social inflation, which is just a fancy way of saying lawsuits are getting way more expensive.
So one way to play that could be a pairs trade. You'd go long WR Berkley, betting that the best-run company will outperform, and at the same time you'd short the whole insurance sector using an ETF, like the KIE. That way you're betting on Berkley to win while protecting yourself from the industry's problems.
And of course, we have to end with this. Remember, everything we've talked about today is for informational purposes only. It is absolutely not financial advice.